Hey, hello everyone. Welcome to Investnowexpress. This is your friend Animesh. Today we are going to talk about trading basics or trading tips part 2. This is an ongoing series that I have been doing. In the part 1, I covered types of trading, I covered certain trading jargons that I used, and I also talked about the do's and don'ts in trading. Today, we are going to look at the price, its history, and also we are going to look at, or we are going to have an introduction to the technical analysis and chart trading. Before we move forward, I would like to ask you to hit that like button, and if you're new, please consider subscribing. Now let's talk about price. Price is the king. Price determines the health of the company, the demand it has or it holds in the market. Looking at the price, you can also predict the future of the company. There is also an interesting fact regarding the market. It's said that history repeats itself. This means you can look at the past and predict the future, right? Not only this, but the market goes exponentially. So, for example, if last year the company has made a profit of, or it has grown by 50%, this year the market will expect the company to grow by 100%. Market always expects exponential returns. Now, keeping these two things in mind, let's move forward to our technical analysis introduction. You know that the Indian stock market opens at 9 o'clock, which is the pre-order session, 9 to 9:15. 9:15 is actually the time the market opens. Right from 9:15 to 3:30 is the market time. There are two stock exchanges which operate for the Indian stock market. It is the Bombay Stock Exchange, BSE, and the National Stock Exchange, NSE. Every day, when this is a pattern, right? Pattern is what? Opens at 9:15, closes at 3:30, right? This is a pattern every day which is followed. This means the stock that we look at will also have a pattern. What is the pattern? The pattern is it will open at a price at 9:15. It will close at a price at 3:30. Within this period of 9:15 to 3:30, it will have its own movement. It might go to a highest point, it might go to a lowest point. So there are four possibilities during the working hours of a day, right? High, low, open price, close price. So this is particular 4 points that we concentrate on for the day, and we plot it on a graph known as OHLC. OHLC stands for open, high, low, close. We are interested in these 4 points, right? What was the opening price? What was the closing price? What was the highest point in the day? What was the lowest point in the day, if at all, right? It might be a case that all the values are the same. It might be a case that all values are different. So in order to visualize that, there is a concept called as candlestick charts. The body of the candlestick chart denotes the open and close price, and the wick denotes the highest point or the lowest point in the day. As simple as that. Looking at this chart, what happened? You can see at 9:15 there was an opening price O. The stock opened, people started buying, but as soon as there was some buying activity, most of the people started selling. So what happened? The stock price fell down. It fell down to such an extent to a lowest point, and at that point people started realizing that no, the stock has fallen too much, let's buy it. So again, people started buying, and at 3:30 it closed at a price. So that's why this graph, you can see OC, right? Open price, close price, and there is a wick which is at a high point, and there is a wick at a lower point as well. So this is nothing but a candlestick chart. Now imagine if you start plotting this chart every day, you will get a pretty clear picture of how this price movement for this stock has occurred. There is another type of chart which only plots the close price for that particular day. It's called the line chart, right? So if you are only tracking the closing price of the stock every day, it's called the line chart. So let's assume that today the stock closed at 10 rupees. Tomorrow the stock closed at 20 rupees. Next day the price was 30 rupees and so on. So for example, if you plot this, you will get to know, you will get a line which is moving from 10 to 20, 20 to 30 in a graph diagram. Whereas if you look at a candlestick chart, it gives you a more in-depth picture where it not only shows you the close price but also the open and the high lows of the day, which is important. Coming back to my first point, that history tends to repeat itself. What do I mean by that? Now correlating these two factors, right? We are plotting every day the open, close, high lows in a form of a candlestick chart, right? And we are also talking about looking at the history. So how will we mix this together? And the answer is very simple. There are three stages in a stock movement, comparing history, obviously. So first is something called as an uptrend. Second is something called as a sideways movement. And third is something called as a downtrend. What is an uptrend? Uptrend means the movement of the stock is in such a way that the low of the next day is higher than the high of the previous day. What does that mean? There is always a high and low movement in the day which is marked, right? So you are marking it. So let's assume that the stock moved 10 rupees, then it fell down a little bit. Again, it went up to 20 rupees, fell down to 15 rupees. 15 is greater than 10. 10 was the highest yesterday, but next day it went to 20 and fell down to 15. So the lower point, which is 15, is greater than the highest point, which is 10. This is something which is called as a high low. So whenever we get a combination of these high lows, we know that the stock is an uptrend movement. Similarly, downtrend. What is downtrend? Just opposite of high low, which is what? Low high. Whenever the high made by the stock next day is lower than the low made by the stock in the previous day. Example, let's assume that the stock price yesterday was 10 rupees, it closed at 10. Let's assume today the price movement was, let's say, from 5 rupees to 8 rupees. So 8 rupees it went up, again it closed at 5 rupees. The high was 8 rupees today. But still the high is lower than the yesterday's closing price, right? So high low. And if you get multiple such high lows, you can say that the stock is in a downtrend. I think the uptrend and downtrend is pretty clear. Whenever you have a high low, you have an uptrend. Whenever you have a low high, you have a downtrend. And sideways is basically there is no movement happening. There is a range bound movement. Then we call it a sideways movement. Since you understood this concept of uptrend, downtrend and a sideways movement, it is important to understand certain thresholds. You might have heard something called as DEMA. 20-day DEMA was this much, 50-day DEMA was this much. DEMA is nothing but DMA, which stands for daily moving average. To explain moving averages, I would need to give you an analogy of a classroom. Okay. So let's assume there are students in the classroom and we are taking tests every day. So some students might perform better. So some students might get 95%, 90% and so on. Some students might perform not that much. So 50%. Some students might perform even bad, 30%. But there will be an average score for the class, right? So let's assume we are taking this average score and plotting it. If we start plotting this average score, right, we'll get a line graph again. And this line graph study with respect to the number of days is nothing but moving average. Now comparing it with a stock, right? Same thing, there is a high low for the stock. So there will be an average. So if we start plotting this point, which is the average point, and start measuring it in terms of days, we'll get a line graph. People look at 20-day moving average, people look at 50-day moving average, people look at 90-day moving average, 100 and 200 and 600 and so on. If you observe that your 200 is the lowest point, then comes your 100, then comes your 50, you can naturally conclude that the stock is an uptrend movement, because 200 days it was because when you compare it to the start, obviously it will, the line will be lower. Then as it progresses, the line will get above, or it will start going to grow in terms of the y-axis. Let's look at an example of ITC. Here you can see two lines. They are nothing but the moving averages. The first line, which is the light blue color, is the 50 DEMA, which is 50-day moving average plotted. The below line, which is the dark blue color, is basically the 200 DEMA. The very first conclusion, or the very first observation that you see, is the 50-day moving average is higher than the 200-day moving average. This means the stock is performing better. This means the company is doing good. Second thing that you observe is the stock is lesser than the 50-day moving average, and it is higher than the 200-day moving average. This means it is in its support zone. You will expect buying over here, because as soon as, let's say, the stock falls even further to 200, that line, there will be an automatic trigger in people's sentiment to buy the stock. This 200-day moving average is kind of a support level for the stock. So there is always a support level and there is always a resistance level during this stock movement. Resistances can be anything. It can be a round figure. It can be, so for example, if you are considering ITC, resistance can be 210 because it's a round figure. 220, again a round figure. Similarly, there might be so many cases where you might have seen that as soon as the stock reaches, let's say 100 rupees or let's say 1000 rupees, which is a round number, people tend to say, okay, the market is high or the stock is high, let's sell it. Even you'll observe this in the Nifty also. If the market reaches 16,000, you will see a drop in price. This is but natural. All right, so our time is up for the video, so I will stop here. And I'll conclude this video with one tip. The tip is that don't be a compulsive trader. Don't be a systematic trader. It's not necessary for you to trade every day. It's okay if this, your money is lying around. When you start trading, what happens is sometimes you get carried away and you start trading every day. It's not necessary. With that said, in the next video, I'm going to cover candlestick analysis in much more detail in terms of pattern analysis and recognition. And I'll also cover the hybrid strategy on picking a stock. Thank you all for watching. Leave your thoughts in the comment section. And yeah, until next time, start early, invest now. Cheers.